What if I told you that when you buy a $400,000 home, the total amount you'll actually pay by the end of your mortgage could be well over $700,000? Most people sign their loan documents without fully understanding this, and that gap in knowledge costs the average American homeowner hundreds of thousands of dollars over a lifetime. Today, we're going to fix that. Welcome to the Loan Desk. Stay with me through this video, because what you learn here could literally save you a small fortune. How mortgages actually work. Let's start at the beginning. When you buy a house, there's a very good chance you can't pay for it all at once. So you go to a bank, and the bank pays for the house on your behalf. In return, you agree to pay them back with interest over a set number of years, usually 30 years or sometimes 15. That agreement is called a mortgage. But here's what most people miss. A mortgage isn't just about borrowing money. It's about renting money. The bank isn't giving you anything for free. Every single month you write that check, you're paying the bank a fee for the privilege of living in your home before you've fully paid for it. Your monthly mortgage payment has two parts. First, principal. That's the actual loan amount you borrowed, being paid back slowly. Second, interest. That's the bank's fee for lending you the money. Where it gets complicated, and where most borrowers lose thousands without realizing it, is in how those two parts are divided each month. The amortization secret. Here's the part the bank doesn't put in big bold letters on your loan documents. Let's say you borrow $300,000 at a 6% interest rate on a 30-year mortgage. Your monthly payment comes out to roughly $1,799. Sounds manageable, right? Now here's the part that will shock you. In your very first payment, that $1,799 you write, only $299 actually goes toward paying down what you owe. The other $1,500 goes straight to the bank as interest. Read that again. In month one, you paid $1,799, but your debt only went down by $299. This is called amortization. The bank calculates your interest first every month based on your remaining balance. And since your balance is huge in the early years, so is the interest. You are paying the bank the most when you can least afford to. By year 5, you've paid $107,940 in total mortgage payments, but your balance has only dropped by about $14,000. Where did the rest go? Interest. By the halfway point, year 15, you still owe more than you borrowed per year on average. The math catches up eventually, but it takes decades. By the time you finish paying off that 30-year mortgage, you'll have paid almost $348,000 in interest alone on a $300,000 loan. You borrowed $300,000 and gave back $648,000. That right there is why the total cost of homeownership is so much higher than the purchase price. This isn't a scam. It's just the math of compound interest working against you instead of for you. But now that you understand it, you can fight back. How refinancing can save you thousands. One of the most powerful tools a homeowner has is refinancing. Refinancing means replacing your current mortgage with a new one, ideally at a lower interest rate. Here's why that matters so much. Because of the amortization schedule we just talked about, even a small drop in your interest rate can save you a massive amount of money. Let's use a real example. Imagine you took out a $300,000 mortgage at 7% interest. Your monthly payment is about $1,996. Now imagine rates drop and you can refinance to 5.5%. Suddenly your payment drops to $1,703. That's nearly $300 a month in savings. Over a year, that's $3,500. Over 10 years, $35,000. But wait, there's a catch. Refinancing isn't free. You'll typically pay closing costs, things like loan origination fees, appraisal costs, and title insurance. These usually run between 2% and 5% of your loan amount. On a $300,000 loan, that's $6,000 to $15,000 up front. So how do you know if refinancing is worth it? You calculate the break-even point. Divide your total closing costs by your monthly savings. If you save $250 per month and closing costs are $5,000, you'll break even in 20 months. If you plan to stay in your home longer than that, refinancing is a win. A general rule of thumb: if interest rates drop by at least 1% and you plan to stay in your home for at least 2 more years, refinancing is usually worth a hard look. One more thing to watch out for: when you refinance, you're often resetting the clock on your loan. If you're 8 years into a 30-year mortgage and you refinance into a new 30-year loan, you've just added 8 more years of payments. Sometimes it's still worth it, but you need to run the full numbers, not just the monthly payment. Strategies to pay off faster. Here's where things get exciting, because small changes in how you pay your mortgage can have enormous results. Strategy number 1, bi-weekly payments. Instead of making one payment per month, you split your payment in half and pay every 2 weeks. Because there are 52 weeks in a year, this gives you 26 half payments or 13 full payments instead of 12, one extra payment per year. That doesn't sound like much, but on a $300,000 loan at 6%, making bi-weekly payments cuts your loan term from 30 years to about 24 years and saves you over $60,000 in interest. Strategy number 2, extra principal payments. Whenever you have extra cash, a bonus, a tax refund, birthday money, put it directly toward your mortgage principal. Because of front-loaded amortization, every extra dollar you pay early has a multiplied effect. Paying an extra $200 per month toward principal on that same $300,000 loan cuts 6 years off your mortgage and saves you $74,000 in interest. Strategy number 3, consider a 15-year mortgage. Yes, the monthly payments are higher. A $300,000 loan at 6% over 15 years costs about $2,531 per month, compared to $1,799 for the 30-year. That's $732 more per month. But over the life of the loan, you save almost $200,000 in total interest, and you own your home free and clear in half the time. The right strategy depends on your income, your other financial goals, and your risk tolerance. But the point is this: you have more control over your mortgage than the bank wants you to think. The mistakes that cost borrowers the most. Let's talk about what not to do, because these mistakes are expensive. Mistake number 1, only looking at the monthly payment. Salespeople, whether it's a car dealership or a mortgage broker, love to focus on the monthly payment. It sounds small and manageable, but a lower monthly payment often means a longer loan, which means more total interest paid. Always compare the total cost of the loan, not just what you write each month. Mistake number 2, cash out refinancing for lifestyle spending. A cash out refinance lets you borrow against your home's equity. Need $30,000 for a kitchen renovation? Your home value went up? You can pull that equity out. This can make sense for home improvements that add value, but using your home equity to fund vacations, cars, or consumer debt is a dangerous trap. You're turning short-term spending into a 30-year debt secured by the roof over your head. Mistake number 3, not shopping multiple lenders. Studies show that borrowers who get quotes from at least 3 lenders save an average of $1,500 over the first 5 years of their loan. Interest rates and fees vary significantly from lender to lender. Spending one afternoon getting multiple quotes could save you thousands. Mistake number 4, ignoring adjustable rate mortgages, or ARMs. ARMs start with a lower rate that can rise after a fixed period, often 5 or 7 years. If you plan to sell or refinance before the adjustment period, an ARM can save you money. But if you stay longer than expected and rates rise, your payment could jump hundreds of dollars per month. Go in with eyes open. Here's the bottom line: a mortgage is likely the largest financial commitment of your life. Understanding how it actually works, amortization, refinancing, payoff strategies, doesn't just make you a smarter borrower, it puts real money back in your pocket. The bank understands every line of that contract. Now you do too. If you found this valuable, do us a favor and hit that subscribe button. Every week on the Loan Desk, we break down mortgages, refinancing, and lending, so you can make decisions with confidence and keep more of your hard-earned money.